You budget, you plan, and you count on your financial foundation staying solid. Heading into early 2026, homeowners were expecting that foundation to settle. After years of high post-pandemic inflation, central banks had begun lowering interest rates. The math on borrowing was supposed to get easier. Then the easing stopped. The Federal Reserve and the Bank of Canada both halted their rate cuts, announcing a long pause. Borrowing costs were frozen right where they were. Domestic data like unemployment and consumer spending didn't fully explain this sudden freeze. So why did the promised relief vanish? To find the reason your mortgage stayed expensive, you have to look past your local bank statement. The answer lies across the planet, in a very specific, narrow stretch of water. In early January 2026, widespread protests escalated across Iran. As the unrest grew, the threat of direct military intervention by the United States increased. Looking at this map, you can see the Strait of Hormuz bordering Iran, a critical bottleneck for the world's energy. Every day, roughly 20 million barrels of oil traverse this passage, accounting for about 20% of petroleum consumed globally. When a passageway this vital faces a credible physical threat, commodity traders react immediately by adding a war premium to the price of oil, prepaying for the risk of a severe supply disruption. A military standoff near this single waterway cascades through financial markets, turning a regional conflict into an immediate worldwide economic panic. Because of that war premium, the price of Brent crude oil spiked, surging past $100 a barrel. Oil that expensive immediately drives up the cost of global shipping, making it far more expensive to move cargo across oceans. It also raises the overhead for manufacturing. Nearly every consumer good relies on energy to be produced. Economists call this chain of events an energy shock. An energy shock drives up prices across the board, artificially inflating the consumer price index. It looks exactly like broad domestic inflation returning. Central banks rely on that consumer price index to make their decisions. They cannot safely lower interest rates while headline inflation numbers are climbing. If they attempt to fight this price spike by raising interest rates even further, they risk choking off borrowing completely and triggering a recession. But if they cut rates to stimulate the economy, actual inflation could ignite alongside the high energy costs. The dilemma grew even tighter when the U.S. administration announced a sudden 25% tariff on goods from countries dealing with Iran, injecting massive uncertainty. Trapped in this catch-22, policymakers chose the safest route. They did nothing. That forced paralysis in Washington and Ottawa is exactly why your local mortgage payments stayed high. By May 2026, the geopolitical temperature finally dropped. Reports of an initial U.S.-Iran peace agreement began to circulate, and the Iranian Navy announced the Strait of Hormuz would be safe for vessels to pass through. This chart shows the immediate market reaction. You can see the data line plunged nearly 11% overnight, sending Brent crude tumbling from over $100 back down to around $97 a barrel. Financial markets breathed a sigh of relief as the pressure valve released. Yet the brief crisis revealed how exposed domestic economies are to external shocks. The numbers on your mortgage or credit card are linked directly to a volatile global web. Understanding your own wallet now requires watching